Kyle, I'm going to go ahead and set you as a co-host so that you can share your screen.
Sorry, say that again, Jack.
I'm going to set you as a co-host so that you can
Perfect.
share your screen.
Perfect.
Kyle, I'm going to go ahead and set you as a co-host. All right, well, I guess I will just set it when I conclude it, because it doesn't look like it's going to let me do it right now without taking my host away. Okay, we'll give it a few more minutes before starting. Three more minutes and then we'll start it up. All right, I think we can go ahead and kick it off. I think people will continue to trickle in a little bit, but yeah, let's just get on with it. So, hi everyone. Thank you for joining us today for the Miami University Blockchain Club Blockchain Accounting Summit. We're really looking forward to getting everyone up to speed on the intersection of blockchain and accounting in 2020, and we're going to do that with 3 different sessions. The first of which we're in right now, which is a workshop, and I'll let everyone introduce themselves in a moment. Secondly, which is our spotlight event of the night, is a panel on blockchain in the accountant's emerging technology toolbox. And we are fortunate to have Noam Heller, Director of Finance and Operations, or Finance Operations and Strategy at PwC, as well as Chen Zher, Partner and US Blockchain Lead at EY. And special thanks to Michael Heil, CEO of 10xTS, for moderating that. Really quick, I guess I'll just run through it. Finally, we have a product demonstration of EY's blockchain suite, including an enterprise resource planner and a blockchain analyzer. And final thank yous. Thank you so much to Kyle Kaufman and Dr. Brian Ballou, both of whom are on this call, for their help orchestrating this event. So let's roll into the introductions. So I'll go first. My name is Jack Gilchrist. I am studying computer science, and I'm also the president of Miami University Blockchain Club. Beyond that, I am the co-founder and chief technology officer of Blocks Consulting. Alex, you want to go?
Hi, everyone. My name is Alex Stan. I'm a junior accountancy major here at Miami University. I'm also the vice president of professional development for Miami University's Blockchain Club.
Brian Ballou. Dr. Ballou, do you want to go next?
Sure. Yeah, my name is Brian Ballou. I'm the Ernst Young Professor of Accountancy. I'm also the co-founder and faculty fellow for the Isaac and Oxley Center for Business Leadership here. Been in Miami for about 17 years, and I also head our curriculum development efforts. So for the last 9 or so months, I've been doing a pretty deep dive into blockchain. So I'm here as kind of a go-between for those of you who are new to it, as somebody who's recently pretty new to it, and the experts who are going to be on the call who know a lot more about it from a technological perspective. So glad to be here.
Hi, everyone. I'm Kyle Kaufman. I am an assurance senior manager with Ernst & Young out of the Columbus, Ohio office. Very honored to be here today. Very exciting topics. I'm going to leave everybody with my tagline. When I look back at my career, I'm hoping my first half of my career was pre-blockchain, and my second half is the blockchain era, just like our parents had the pre-internet and pre-computer era.
And hey, everybody, my name's Mark Vangeloff. I'm a manager in EY's enterprise risk consulting practice. I kind of have a dual background in both accounting audit as well as IT audit. So my interest and passion has really lies at the intersection of risk and emerging technologies, and have really, just started on my journey of blockchain. But glad to be here today and honored to be invited, and looking forward to a great discussion.
All right, let's jump into it. So we'll go over a couple of key points on what blockchain actually is first, before handing it over to Kyle and Mark to go a little more in depth on how this all actually plays in the accounting profession. So let's ask the question, what is blockchain? So the first thing is that blockchain is not Bitcoin. If that's what your impression of it is, we're here to kind of get you in the mindset of it being a revolutionary technology that can be applied in a lot of different business contexts. So to break down the actual technology of it, it is essentially a decentralized immutable ledger. which still probably doesn't mean that much. So let's take a look at this graphic and compare a centralized database and a decentralized database. And we can actually see that there are what are called nodes connecting to all of these different places, all of these different computers. So to put it more concisely, distributed means that there are multiple networks of computers serving the information up to the connecting users, rather than a single centralized computer network, such as Google, for instance, serving it all up. And on top of this, it also has something called a consensus mechanism, which is the process whereby when someone tries to do any action on the network, say spend $10 or open a document, the network will actually verify whether or not that action is permitted. And everyone on the network will establish a common opinion on that action before rejecting or committing it. So in the instance of spending $10, if you only have $8, it should reject it. And if you are shared on something like a Google document, then it should approve you opening that document.
Yeah, real quick while we're switching, what that means for you accountants is that the controls, which typically would have been inside your company or your client, are now across the entire distributed system. So it's a very different kind of control environment.
Now it's important to take a look at a little bit of the history of blockchain and how it actually started. And you can see by this graphic that it started all the way back in the 90s is when the idea first came to be, but it didn't really take off until 2009, when Satoshi Nakamoto released the Bitcoin white paper. And a white paper is basically just you can find it online if you type in BTC white paper, basically any coin out there, and basically describes the technology behind it and how it works, what it could be used for, and all that kind of good stuff. And then, as you can see, in 2010 is when Bitcoin was released and you could purchase it. And it wasn't until 2012 where transactions really came to be. And then 2013 is when the Ethereum white paper was released. And this was very big because now this is when smart contracts really began. And it was basically started to be used more in businesses and that kind of stuff. And in 2016 and 2018 is when you can really start building with blockchain using whatever protocol you would like. And now in 2020, it's evolving more. It's still kind of in the developing phase, but pretty soon it's going to be mainstream and be used all over.
And again, kind of just to refresh as you're going through here, Bitcoin, Ethereum, these are cryptocurrencies. So just think about it as kind of cash on the blockchain as opposed to typical monetary transactions you would have in a traditional system.
So another term that you will hear very frequently, or terms, I guess, is private and public blockchains. So they are fundamentally pretty different in how they operate, and there are 4 key ways that we've highlighted that they actually differ. So first one is access. On a public blockchain, it is unrestricted. Anyone can connect to the blockchain, assuming they have an internet connection. With a private blockchain, whoever set up the network, whoever owns that network, actually gets to determine who will connect. And this is called, to transition to participation, a permissionless blockchain in the example of a public blockchain. You're not asking anyone for permission to actually connect to the blockchain. And the consequence of this is that it's also pseudo-anonymous, which means that the address or account that you are interacting with on the blockchain cannot be tied back to your identity without resources being invested to actually connect it to you. There's no direct link. And a private blockchain is pretty much the antithesis of that. It is permissioned. So again, the owner gets to determine who gets on the network, as well as setting various permissions with respect to all the different actions on the network. And all the identities that are actually on this network that joined are known to every participant. So in a public blockchain, and we did talk about consensus a little bit, but in a public blockchain, there is proof of work and proof of stake as the 2 most common consensus mechanisms. And these are both fairly heavy. However, proof of work, which is used by Bitcoin, is by far the least efficient, and proof of stake is much closer to a more workable commercial solution, but still does not sacrifice decentralization for speed. Whereas a private blockchain, which does not require any sort of decentralization of power, can rely on something called proof of authority. So in order to actually commit blocks, commit transactions, do any action on the network, you simply have to have the authority to do so. And finally, the performance of all these, again, comes down to that security mechanism. So on public blockchains where they're using heavy consensus mechanisms, proof of work, proof of stake, they have to run these consensus mechanisms on every single validator on the network. And there are many validators on a public blockchain. And this results in a very slow network. Whereas a private blockchain has very few validators. So because only a few people need to check off on it, transactions can be made very quickly.
Next thing we're going to look at is what a smart contract is. And a smart contract is basically the idea that you can create a contract over computer code. And if you think about like from any basic coding class, if statements, that if you think about it that way, there's no need for a third party like a bank. And it's typically on the ETH protocol. And when you make an agreement, it'll be activated when the conditions are met. And it's typically stored in a public blockchain. And this gets rid of the need for any bank or third party. It's all on the blockchain. It's all in the coding. So it's very secure. And once the conditions met, the agreement will go through. And here's a little graphic if it helps you visualize it better. It's just like two people making an agreement, but in code, it's processed in the blockchain. And once all the conditions are met, the agreement goes through. No need for any third party, secure and private.
Yeah, and real quick, maybe just to jump in for a second, if you want to think about the blockchain versus a smart contract, blockchain will change accounting in many ways. It'll change the way you would audit, or you would take a look at a control setup. But if you think about the change for business, and I think Alex mentioned this earlier, the smart contract is what fundamentally changes how business is conducted, because you can have transactions instantly occur when a condition happens. So if you're a tax person, you could have a situation where a company makes a sale and instantly, as of the moment that sales transaction occurs, the state taxing authority is given its percentage of sales tax. There's no need for any further transaction, no need for any remittance of tax. It's automatically done. So it gives you a little idea how there's a difference between how something is accounted for and how it actually transacts in business.
Yeah. So another fundamental technology behind blockchain is its use of cryptography. And we're not looking to go super in depth on all the math, but essentially we are talking about something called a hash function. And what we're trying to do by using a hash function in a blockchain is save space, obscure data, and provide a provable outcome based off this hash function. And the consequences of those are that you can create authentic and irreversible transactions, of course, in the event that the blockchain is not attacked in 51% attack or some other vulnerability. But let's go take a look at the actual mechanics of a hash function. So the phrase, "the red fox jumps over the blue dog," outputs a digest beginning in 0086. And you can see it's the second to top in the graphic. But if we change just a single letter in that entire phrase, so over, we're going to change to OUER. The entirety of that output, called a digest, is changed. So again, just comparing the first four letters of each, you can see that it's changed from 0086 to 8FD8. So by employing a hash function, we can, without having to see directly the data, determine whether or not the data has integrity.
Now we'll look. Now we'll take a little look at oracles. This is basically the medium between the blockchain and real-world data. This can be anything like the price of a stock, temperatures of a fridge, the speed of a car, and this requires a degree of trust in the data source. There needs to be trust there so you can pull from the outside. And it typically pulls when a transaction is involved. And the smart contracts are a typical way of the Oracle uses to pull data. And when the conditions met, it pulls that data into the blockchain.
And the final term that we think everyone should know in this context is a tokenized asset. And the process of tokenizing an asset essentially boils down to creating a unique digital identifier for this asset and relying on custody on the blockchain of this digital token to represent custody of the real world asset. And the result of this is much higher liquidity, faster settlement, all while relying less on brokers. And in certain situations where we're trying to securitize assets potentially, we can even enable fractional asset ownership, which is something very novel. Robinhood has just gotten around to it, but we're still trusting Robinhood in this instance, where a blockchain can natively support fractional ownership of assets. And these assets are completely arbitrary. It could be a stock, it could be a house. So for instance, you could take 1/100th of a house and receive rent payments, 1/100th of the rent payment, but it doesn't have to be that as well. It could be a non-financial asset that we're still trying to track chain of custody with. So for instance, a prescription, we would like it to be liquid. We would like it to settle quickly when we go to the pharmacist and hand them the script, and they would like to trust that the script they're getting actually came from a doctor. So by tokenizing this asset, we can automate a lot of the trust required around it. So now we're going to turn it over to Kyle and Mark.
Thanks very much, Jack. I'm going to share my screen. Oh, I might need you to,
Yeah, you should be good now.
yeah, enable me to share. Perfect. So hi again, everyone. Very excited to be here today. Again, I'm Kyle Kaufman. I'm an assurance senior manager in our Columbus, Ohio office with Ernst & Young. I spent 10 years of my career auditing clients in the pharmaceutical distribution industry, consumer products, retail, manufacturing, and local not-for-profits. One of my great colleagues, Mark, is also here as well. Mark, I'll let you say a quick bit. Nice wave. And
thank you, Kyle.
Before we start, I want to focus on three key things today. So if we're going to walk away from these 30 minutes with three key tools, they're going to be this. First, we're going to start off with the history of technology. Technology pretty much follows what we'll call a pseudo parabola in both growth, speed, and efficiency. From there, we'll focus in on a couple key blockchain concepts to piggyback on Jack's and Alex's first bit. And then lastly, we'll take all of that and really start to relay in audit and accounting concepts and how the world will look very different as blockchain continues to deliver on its promise. So first and foremost, a couple of the MUBC members may have already seen this. I love showing this in every presentation I can. But here are two pictures of Tiger Woods, one in 2002 and one in 2018. As you can see in 2002, there is not one fan in the crowd with a smartphone taking a picture of Tiger. Fast forward to 2018, 16 years later, people aren't really watching Tiger. They're watching their smartphone that's watching Tiger. And the point we love to bring up here is in 16 years, which is a very small period of time on planet Earth, look at what has changed. And we could sit here with a coffee or another choice beverage and talk about many examples like this. Think about music, going from vinyl to cassettes to CDs, to illegal downloading on LimeWire and Napster, to Apple Music and Spotify. And if you just think about television and the fact that we're able to watch a live event through effectively a device thousands of miles away, real time, with fast forwarding and rewinding, it's truly remarkable. So a couple graphs that drive home that point to start off. First is technology adoption in US households. What you can see here is, on the right-hand side, various different technologies that have existed since the early 1900s, whether it's a vacuum, a refrigerator, an automobile, social media, a washing machine, dishwashers, cable TV. Technology adoption goes on these parabolic growth trends. And really, when you look back at all these years, there's really only a short period of time where technology didn't have this significant advancement. And that was during World War II, when obviously the focus of the United States was on very different things. But we love this graph. We think it very visually depicts tons of different technologies over the last 120 years that have seen this large-scale adoption curve. On top of that, some of you may be familiar with Moore's Law. Really what Moore's Law is a theory that the number of transistors on integrated circuit chips will effectively double every 2 years. How we can think about that is the speed of computers being able to double every 2 years and the size of them being able to. So Moore's Law kind of commonly throughout the world has been applied to various other technologies. It's a good example of how technology excels and grows and continues to see these large-scale adoption curves. Lastly, we think this graph does a very good job of some more recent technology that has seen significant growth in the business world. First, if you think about cloud-based data storage, if you look at Amazon and their AWS platform, they launched in 2006. I guarantee you, if you went back to 2006 and surveyed publicly traded companies and said, hey, are you guys going to store your data up on a cloud with a bunch of other companies? Probably got a large-scale resounding no. Why would we do that? Fast forward to 2017, 11 years later, everyone's got their data on the cloud. So 11 years, that's how quickly things change. If we look at banks, pre-1995, there were no account services online. By 2000, 80% of US banks offered e-banking. By 01, after the Y2K scare, everyone's using online features. That's the power of the internet. So bringing that back to the blockchain world and Bitcoin world, you see in 2009, Bitcoin launched, Ethereum launched in 2015, and one that hits home for us at EY is our blockchain.ey.com launch in 2019, which we'll do a demo on a little bit later today, so stay tuned for that. All right, on to EY's strategic vision for blockchain. So what we believe at EY is that blockchains will do for networks of enterprises and business ecosystems what enterprise resource, also known as ERP, did for the single company. We think that really hits home when you think about ERP and the fact that companies formerly did not account using ERP. It's a pretty amazing thing. And what ERP did for the single company, multiplied by what a blockchain can do for a supply chain, we think is really groundbreaking. So from a business context, another key point is that enterprises are struggling to manage large extended supply chain networks that have many tiers across jurisdictions and multiple information systems. Blockchain helps to solve all that. We will start to dive into just how that occurs. So we think this slide does a nice job of explaining the current state versus what a blockchain future state looks like. But if we just take the Apple iPhone, for example, there are hundreds of parts that go into building that Apple iPhone. And Apple has contract agreements with each one of those parties that supply them the parts that go into the phone. Imagine how many agreements that is and how many disparate systems there are between all of the 80 suppliers and Apple. It is a complex process that involves lots of manual reconciliation, disparity of information, and largely a low level of system integration. In a future state with blockchain, we can connect those information systems. Most importantly, create a single source of truth that allows a supply chain to agree on what the terms of that agreement were and what they appear as from a financial statement. Mark, I'll let you go through what we believe are 5 really key questions to ask for blockchain.
Thanks, Kyle. I guess so by now, you're probably thinking, wow, blockchain's amazing. It's going to solve all of the world's business problems. And unfortunately, I'm kind of here to tell you that's not necessarily the case. Blockchain isn't some universal solution that fixes everything. But blockchain technology is very good at solving specific business issues. And to help determine, if blockchain is a good solution or a good fit for a solution for a particular issue that you're having or a client's having, generally we start with these 5 questions. So the first one being, are there multiple parties in this ecosystem? I think, we've kind of covered that a lot already. The network inherently gets more secure the more participants there are. Is establishing trust between all these parties an issue? I would say generally, again, we've covered this before, unequivocally yes. And blockchains are by design able to improve trust between participants by providing multiple points of verification and increased transparency in the network. Third, is it critical?
If I can jump in one real quick, the other aspect of the trust that's really important is you don't have to put as much information in because you're pushing transactions versus pulling them. So all that personal identifiable information that companies could, your personal, address, your bank accounts, some of those personal information, you don't have to share that as much. So there's less out there that can be hacked. So that's another benefit. You can put less information out there, which from a company perspective lowers their risk for leaks of confidential information.
Yep. Third here, is it critical to have a tamper-proof permanent record of transactions? And I think that should go without saying. Yes, and as Jack talked a little bit about earlier, blockchains create permanent records that can't be edited or deleted without detection using cryptographic hashing. 4, are we securing ownership of a finite resource? Really, what blockchain does here is based on the core logic in the system. It's designed to prevent double counting of assets, and really is meant to record ownerships and transfers. So if somebody says, digital dollar, that's kind of what they're getting at, because you can't, the network protocols are inherently designed to prevent double counting of assets or tokens that are used to transact on the network. And finally, 5th, does the ecosystem benefit from improved transparency? Again, blockchains are transparent by design, right? You want an ecosystem of people participating in an open forum. And so you're able to kind of track and trace ownership or control of assets as they move through things like your supply chain.
So the key piece here is, if you're an organization and you go down that list of 5 questions and your responses are yes, blockchain has the potential to do some amazing things. This slide is a great summary of 6 simple things that everybody can put in the back of their minds for an organization that drive efficiencies. 1, increase transparency across your industry ecosystem. 2, eliminate manual transactions. 3, automate contract execution, audits, and reporting. We'll go through a great example of that a little bit later on. 4, the single source of truth aspect. 5, data accuracy and enable real-time analytics. 6, integrating siloed systems.
Yeah, and I think if we simply think of this in terms of audit and financial statements or IT systems, number 4 simply cannot be overstated enough, right? If if given the opportunity, any auditor is going to tell you it's much easier to audit one thing as opposed to many things to achieve the same level of coverage of risk. So I think, to me, that's the one that stands out.
Yeah, if you think about it from an audit perspective, existence being something that the first thing you learn in auditing is confirming an account receivable or observing inventory. No need. As Mark just said, that's gone.
I think Jack did such a good job on his overview. I'm not sure there's really anything I need to go through here.
I agree.
Same with this one.
So this next slide, what Mark and I, as we've had some coffees together over the years, what we tried to do was to come up with a 4-word definition for what blockchains are. The best we have done so far, and we're open if others have a better 4-word description of what blockchains are, is a secure shared trust machine. I think humans do a lot better thinking of things as a tangible object, like a machine. And really, that's what these blockchains are. They're a machine that are constantly churning out transactions based on code that evaluates whether conditions are occurring. And if they do, we see something like movement of a Bitcoin from wallet A to wallet B. And what we like to do on this slide is very quickly and very simply differentiate Bitcoin from Ethereum. So if we call Bitcoin a blockchain for payments and a store of value due to its fixed supply of only 21 million Bitcoins ever being mined, how a Bitcoin blockchain works is I have Bitcoins in my digital wallet address. I want to send them to Mark. As long as I have those Bitcoins in my wallet and Mark has a valid address, that transaction is valid. From an Ethereum standpoint, if we think about Bitcoin as a blockchain for payments without an intermediary like a bank, the key concept for Ethereum is smart contracts, which Jack did a phenomenal job of explaining. But that smart contract functionality is what makes Ethereum what we like to call store of utility and a great case for enterprise blockchain use. So the rest of our presentations today will focus on Ethereum. Again, we'd love to hear from others if you have a better definition out there, but we think this is a very simple way to help explain it. Next time you're with your family over the holidays.
Yep. So real quick, we've kind of talked about what the life cycle of a transaction looks like. This is kind of an illustrative example of that. As Kyle said, like if Kyle wants to send me 5 Bitcoin, he broadcasts that intention to the entire network. So everybody sees that Kyle wants to send Mark Bitcoin. And what the coding inherently does is checks Kyle's available Bitcoin and says, yes, Kyle has enough to send Mark this. And then it asks, does Mark have a valid address? If Mark does, send the Bitcoin. And once the network has kind of done its checks, all or a subset of nodes, depending on the protocol that's being used, will basically conduct the consensus mechanism, proof of work, proof of stake, whichever you're operating under, and that's kind of the final gateway before a transaction is then added to the blockchain. At which point in time, the tokens that Kyle wanted to send to me would then be moved to my address.
And maybe too, for those of you trying to kind of stay current, if you flip back real quick, one of the things there that makes, because you might say, well, I can send anything from one account to another account, and it does it the same way. The big difference here is if somebody went in and changed it or tried to hack you or they would have to change all of those nodes at the same time pretty much to be able to do it. And that's what makes it much more difficult to have any fraud or have anybody renege or change anything, because once it's out there, you have to, everybody has that same version of the truth. So if you change one, you'd have to change them all, or instantly the system says something's up.
Yeah, and if we go back to that concept of pseudo anonymity, what that means, and I guess my example wasn't great because I used our actual names, but on the blockchain ledger, individuals are represented by their public keys, which is just a public key. Cryptography is another cornerstone of blockchain technology because that allows you to digitally sign transactions, which are in essence proving to the network that you are in fact the owner of the keys that own or are associated with the Bitcoin that you're trying to send. So really you would be represented by a series of random numbers and letters on the network.
And this brings up what many of you may have heard of before is the need to, now you have to have physical controls over that key, because that key is the bearer bond. If you have the key, it's like holding $1 in your hand. So if you lose the key, you can't get to the money. And since it's a distributed network, nobody knows that you owned it and nobody can ever give it to you. So it's very important that how you put numbers in, lock boxes. Sometimes you'll have a code set for 2 out of the 3 people have the code and 2 of you need to have it. There's all kinds of new risks because physically somebody has to have that code to be able to access your cyber currency, your Bitcoin or whatever.
I think a common misconception is that the network is somehow verifying that the person sending the Bitcoin is the right person, but in reality, the network only checks whether or not that address owns those Bitcoin. So back to your point, Brian, it is like exactly like a bearer bond. And so as this presentation was essentially part of a lunch and learn CPE session that Kyle did, but we broke it up using polling questions and, just to kind of make sure people are still awake, feel free to type in the chat what you think the answer is, but a digital representation of a physical asset on a blockchain is known as a token, full node, ETC, smart contract. And I see we're getting tons of answers, so I'll just go. I'll go ahead and say it's a token, and I think we can move on to the next slide.
All right, so we've conquered steps 1 and 2, history of technology, focus on key blockchain concepts. We're moving to bullet point 3. And to tackle what we believe are really key audit and accounting concepts related to blockchains, we're going to first lead off with, what do external auditors do? So if you're EY, if you're PwC, Deloitte, KPMG, regional firms, and you're auditing a publicly traded company, what's your output? It's 2 things. 1, an opinion on the consolidated financial statements. So that is an external auditor providing reasonable assurance that the financial statements are presented fairly and in conformity with US GAAP. Second is an opinion on ICFR, which can be defined as internal control over financial reporting. And these are controls that companies, aka management, are responsible for upholding. In an ideal world, if a publicly traded company's controls are operating as designed and effectively, there really should never be an issue identified by an audit. But after Enron and WorldCom, which everybody's familiar with, Sarbanes-Oxley Act of 2002 came out, in came opinions on ICFR. So to build on these concepts, knowing that this is what external auditors are responsible for, what Mark and I did was want to lay out first some common control considerations to get a better understanding for what management is responsible for. They operate their controls. And second, what it looks like for an external auditor to test the financial statements. So what we created was a very simple business scenario that we'll build upon as we move throughout the rest of the presentation. But what that scenario is shoe manufacturing company Kyle's Shoes sells products to its customers, the shoe stores. based on the number of purchases from each shoe store and the terms of the agreement between parties, Kyle Shoes owes rebates to its customers. At a very high level, I manufacture shoes, Mark is a shoe store. We have an agreement that specifies terms of our agreement. Included in that might be a rebate that says, every time Mark buys 100,000 pair of shoes from Kyle, Kyle owes a 10% rebate. So as an external auditor and getting comfortable with that rebate dollar amount, from a financial statement standpoint, we need to do testing. And what testing of it looks like is getting the actual contract, getting sales downloads and proof of delivery to sufficiently prove out that the amount I have calculated that I owe Mark is accurately reflected in Kyle Shoes' financial records. The same thing is effectively done by an external auditor for Mark, except for Mark, it's a rebate receivable. But the auditor needs to get the agreement, check what's recorded in the financial statements, inspect the total number of goods receipts, and ensure that the rebates receivable that Mark has recorded on his financial records are accurate. So in the current day, you can see external auditors are auditing both ends of these transactions. From a control standpoint, it's really the same concept, except management is responsible for adhering to policies and practices to ensure that they're calculating the rebates appropriately. So from a seller standpoint, they have a control that monitors and assesses that rebates are being calculated appropriately, that are owed to the customer. Same thing on the customer side. Is our rebate receivable balance accurately stated? They have a process to make sure it is. That's auditing in the current day. Mark, I'll let you do a couple IT concepts before we move to the future.
Thanks, Kyle. So from an IT perspective, generally the objectives are the same of an audit. You want to make sure that if something has been done to an IT system that supports a transaction, management is aware of it and has controls in place to mitigate the risk that comes with that. So if we think in terms of Kyle's example, he's the financial statement auditor and I'm the IT auditor. And what I would be doing is then test the controls that management has designed and implemented over IT systems to ensure that risk is mitigated sufficiently so that the financial statement auditors are able to rely better on the reports that are coming out of the system. And you can think of it in terms of a lot of the nature and the timing and the extent of the procedures that the financial statement audit team does is dependent on the testing that the IT audit teams do. And generally speaking, we really only think about IT auditing in terms of controls initially. The substantive testing and procedures occur if you find one or more control failures in any given process. And again, generally speaking, all IT systems have the same or similar baseline risks, and we address these risks with what are called IT general controls. Really controls over how changes are managed over the IT production environment. Access management, so controlling who has access to what and to what extent that they can access things. And then manage operations, which is really about managing and monitoring, scheduled jobs, automated integrations, and IT incidents and backups to ensure that, these things are completing according to their programming and any issues are resolved in a timely manner. So really, I think it's important to note that within the context of blockchain, these risks are still going to exist, blockchain or not, really, because blockchain is just another IT system. you're still going to have manage change, manage access, manage operations. It's just that the ways in which these risks manifest and how management addresses them can potentially change drastically due to many factors. And for example, there are additional systems and tools that will need to come into scope for an audit if a blockchain solution is implemented. And I think about things like token management and custody solutions, like crypto wallets. As auditors, we would have additional considerations around access provisioning, password and key management, segregation of duties with respect to hot and cold multi-sig wallets, as well as third-party exchanges that might manage the keys for a company. Also, I think another big one that you'll keep hearing about is change management as it relates to smart contracts. We would have to adjust our audit approach to consider change management with regard to more agile development environments, taking into consideration potential segregation of duties issues, multiple code pushes done concurrently. So we really have to think about how we're getting more technologically savvy with regards to coding and programming languages, because until this technology has evolved to the point where, people just accept the fact that it works, it's going to be incumbent on the auditors to really understand the nuts and bolts of these smart contracts. And then lastly, the last example I can come up with is, in terms of transaction processing and failures or confirmation of failures, it becomes more of an integrated process between companies in this ecosystem rather than a self-contained process for resolution within a single enterprise, because you're going to have many unique entities interacting and operating on one shared network.
Yeah, so if I could just jump in for a second. Mark mentioned a whole lot of things in that conversation that if you had not been familiar with blockchain would go right over your head: hot wallets, cold wallets, those sorts of things. And what I want to mention here is the driver for controls for most public companies is COSO. And COSO has traditionally been, it's been updated, but it hasn't really changed much since 1992. But there's a brand new COSO out, and it's on blockchain. And it basically says this: the roles and skill sets for all types of accountants. So if you're the client side, if you're going to go work for a company, you're going to have a different set of skill sets. And if you're an auditor or a tax professional, you're going to have a different set of skill sets. And even if you're an internal auditor. So across the board, if you learn nothing else tonight, you should run towards this stuff, not away from it, because you're going to be expected in the next 5 to 10 years to get much more comfortable with a lot of the things Mark's talking about. They're not that hard. It's just different. And so you have to have to embrace them and learn them, because a hot wallet, cold wallet is just whether or not your digital key is hooked up to the internet or not. But it doesn't, that seems new and very confusing until you get comfortable with those terms. So I just wanted to pause there to kind of let you know that there's a lot of lingo, but it's easy to kind of get over it once you get comfortable with the basic idea.
Yep, well said, Brad.
And really the last couple points I'll make, because we'll move to questions here in a minute, but in today's world, when you look at controls that companies have and how auditors test them and how auditors test various accounts within a financial statement, it is lots and lots of paper or PDFs and manual processes. Downloading reports, getting a contract, ensuring that the appropriate rebate percentage is being multiplied by the total number of sales. Up and down every single agreement that a manufacturer and a customer have. Where blockchain's promise comes is that it creates a single source of truth, and it's effectively a machine that is churning out all of these results, rather than a human process like we elaborated on in the rebate example, that's taking a download of a report and the percentage from an agreement. So I think we can all start to see that blockchain as automation, especially if you're a company, if we go back to the Apple example from early on, where you got 80 different supply agreements for all these different parts and all this data moving from all these different systems. By blockchain having that programmed within smart contract that has all those rebate terms loaded vastly changes this. So Bill Wolf's going to do a blockchain analyzer demo later on that discusses a tool that we have that basically compares the results of an ERP with on-chain transactions. And skip the last poll, but the last thing we have to do today, because we do have some great future accountants on the line, is talk about how to account for cryptocurrencies. Very simply, as things stand now, and things certainly may change, cryptocurrencies are recorded as intangible assets subject to accounting standard 350. The biggest key concept here is that a gain on a crypto asset should not be recognized until you sell it. However, just like an intangible asset that's not subject to amortization, if there is significant loss, aka an impairment, that impairment should be reported. So with that, that is a ton of information. We will open it up to questions.
Yeah, and I would just to chime on to the accounting for cryptocurrency today. Probably one of the bigger audit issues out there that I'm hearing about is that if you have a client that holds cryptocurrency, then you have to get some sort of proof of reserve to make sure that they may have it at some online quote unquote hot site, hot wallet. So you want to make sure that they actually have that. So that's the short term. Before you get into the actual blockchain analyzer, just the fact that you hold currency, you've got to get comfort that that currency is really held by whatever that party is that's the custodian for that right now. So that's kind of a 2020 kind of audit issue. But I think to the point that Kyle and Mark are making, you're 5 years away from what you're going to hear in the third hour, which is no more work papers. We're just going to be using the blockchain analyzer and have a fundamentally whole different way to think about our jobs.
All right. Well, thanks for listening to us, everybody. Very much appreciate the time and any questions you might have.
Yeah, I can go ahead and
Jack, I will stop sharing, FYI.
out there. Yeah, so I guess I'll just go with this. As let's say an accounting professional trying to figure out how to implement a blockchain, what would they want to look at with respect to actual platforms, and what are some other considerations about actual implementation that are important in 2020?
I think, it all starts with what the intention of the blockchain or the coin or the token you're trying to create is. And that might sound like a very consulting-esque answer because it depends, right? There are all sorts of different ways to implement a blockchain. They all just have to have very similar baseline protocols that achieve, the immutability of the records, the consensus of the network. And once you've kind of figured out, okay, I want this to be a publicly available blockchain. I want it to have a proof of stake consensus mechanism. I think those are kind of the building blocks that you need to really get started, because once you start getting past that, now you're starting to think, all right, well, which blockchain protocol am I going to build this off of? Do I want to take a fork of Bitcoin? Do I want to take a fork of Ethereum? Really, there are a lot of options, but I think if you step it into what are the most basic things you're trying to achieve and work from there is going to be the most important.
Yeah, this might be a good time to add in another key aspect, particularly for those of you accounting majors. We start into these kind of technologies, particularly it's so poorly understood right now what a permissioned versus a permissionless blockchain is. You're going to have to learn how to communicate to executives and leaders. I teach a lot of executive leadership, so that's both corporate governance, that's the board of directors, who have an audit committee who's going to have something to say about what your data is, what's going on with your data, and they're the ones working with the auditors. And then, just as importantly, the C-suite. For instance, in J.P. Morgan Chase, Jamie Dimon has a lot to say and a lot of influence over what investments J.P. Morgan Chase is making. He was late, he never liked Bitcoin, thinks he likes blockchain. So if you're going to do J.P. Morgan Chase right now, it's going to be permission because he's not willing to listen to public yet, even though, as you learn from EY later, public might actually be the better course of action when you're fully aware of what it means. Doesn't matter. At the end of the day, you got to first convince your key decision makers in your company. You got to educate them, and that's going to be one of the big challenges, I think, in the short run, is how do you get the leaders of a company and other stakeholders, investors, and so on to really get it. And that's why these kinds of sessions are so important, why you want to become more of a champion than somebody who's ill-informed and perpetuating myths.
Yeah, be prepared for a lot of blank looks when you try to pitch a company on transacting on a completely open blockchain ledger. Just because I think at a certain level, people still do equate blockchain with Bitcoin, and people generally are just not sold on it. And
I think of the anonymous as the dark web.
Correct. I won't sit here and say it doesn't facilitate, transactions of unsavory nature, but so does cash, right? That's all it is digital cash. And I think people tend to have a myopic view of all of the bad things that is associated with it, because they haven't really taken the time to understand the underlying proven technology and mathematical innovations that have been kind of put together to make this work. And I'll get off my soapbox here in a second, but if you're really trying to understand the nuts and bolts, I implore you to read the Bitcoin white paper, like Alex mentioned earlier. It really breaks it down in I'm not going to say easy to understand manner, but if you spend some time and try to process it, and it's not very long, nine pages or so, you start to realize, okay, here are the questions that were being asked, and here is how blockchain was implemented to solve that. And really, that's the foundational component for all blockchains. So sorry, I'll get off my soapbox.
And I would say from the accounting perspective, that's where having COSO put a document on what controls look like, EY, have a blockchain group having a blockchain analyzer product. I think that legitimacy comes from the service providers, and the service providers who've done the traditional services say, hey, we're about this, we're moving in that direction. And that's why I think the accounting profession is very valuable in moving it forward, because of the legitimacy and trust that they bring to the table. But I'm not a CPA from EY, so I'll make that plug, and then I'll let EY and PwC take it from here.
Great segue.
Yeah, I think we can probably wrap this session up. So thanks for coming, everyone. Make sure to go over to the Eventbrite and go to the next link for the session with Chenzer, Noam Heller, and Michael Hiles on blockchain in the Accountant's Emerging Tech Toolbox.
And on behalf of the faculty, we appreciate you guys doing this tonight. This is a big help for all of our students.
Yep, go Red Hawks.